Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with ASB. Today we've gotten some big numbers out on the economy. Firstly, GDP for the December quarter. It fell 0.9%. That means New Zealand's economic activity contracted 0.9% in the December quarter from the September quarter. When you compare the December quarter of 2008 with the same quarter a year ago, we were down 1.9%. And if you look at the whole of 2008 versus the whole of 2007, we were down 0.2%. Now what's the story here? What's going on? Well, manufacturing is contracting quite quickly, as is construction. Retail spending is weak, but it's offset by strong government spending and also some strong activity in the financial sector. A lot of us are refixing and unfixing our mortgages at the moment. But the interesting news today, I thought, was the trade surplus figures up to $489 million. Now, this is the strongest February we've seen in 8 years. Now, this is because imports fell quite a lot, 14.2%. Exports were also down, but less, 6.6%. This is because we're buying less oil, it's costing us less because the oil price has fallen, but also we're buying less manufactured consumer goods and cars, which is helping improve that trade surplus, which we really need to do given our big current account deficit. So what does this all mean for interest rates, the currency, and house prices? Well, not much in the short term for the Reserve Bank of New Zealand. There are some good signs in there. The slowdown in consumer spending is helping, and it wasn't quite as bad as some people might have expected. It was about in line with what the Reserve Bank was thinking. But the Reserve Bank has a little bit more extra work to do now. That's because the New Zealand dollar has risen quite a lot in the last couple of weeks, from around 49.50 cents US to about 58 cents US earlier today. And also long-term interest rates, the 3, 4, 5-year rates, have spiked up quite a lot in the last week or two, because interest rates globally are up and also because a lot of New Zealanders are looking to move back into long-term fixed rate mortgages. That forces their bank to go into the market to get the funding for those mortgages, therefore pushing up the yield. So that means the Reserve Bank's monetary policy easing, which includes interest rates, the currency, and wholesale interest rates or market interest rates, as well as fiscal policy, all of those things are a little bit tougher right now for the Reserve Bank as it tries to re-energise the economy. So it may mean it has to cut interest rates even a little bit more next time it meets to decide on April the 30th. Most people are saying 25 or maybe 50 basis points, cutting the OCR from 3% to maybe as low as 2.5%. However, that means variable mortgage rates down slightly, perhaps over the next 6 months or so, but longer term interest rates are rising, and quite quickly, for a bunch of reasons. Firstly, right around the world, governments are borrowing a lot more and they're also printing money, which means that interest rates are rising on expectations of inflation, simply because the governments are having to pay more to get what they want. So we're seeing a swiveling of the yield curve for mortgages. It may mean if you are a fixer, you need to fix a bit long and pretty quickly, but it may actually make sense in the next couple of years if you're looking for the cheapest rate and you believe the economy will stay recessed for quite some time, to actually stay floating, where we're going to see in the next month or two that floating 6-month rate being a lot cheaper than anything else. I'm Bernard Hickey. That was an economic weather report brought to you in association with ASB.